please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Big Deal. Today we have with us Sanjay Nayar, who heads KKR in India, marquee private equity firm. Sanjay, good to have you on Big Deal. Now, since we spoke last time, a lot has changed when it comes to the economics of the world. Like, we are in an environment where there is trade war which is escalating between the US and China, and we have seen hardening interest rate scenario. Crude is on a boil, and emerging markets are seeing some outflows. How do you assess the situation currently?
Look, I think from the emerging markets point of view, it's a pretty uncertain time. But the way I look at this is that this was not unexpected. You have massive fiscal stimulus in the US. You have a continuing easy monetary policy, like you saw what happened with the ECB last week. I think generally these economies are obviously still growing, but when these changes begin to ease and you remove the quantitative easing that is also an overhang,
Yes.
I think the growth in these markets will revert back to the mean. So I think you're going to see lower growth at some point in time once the effect of the fiscal stimulus plays out and the monetary easing goes away. Compound that with the fact that hardening of rates is there to stay for some time. So that's going to be negative for emerging markets. Thirdly, the trade war reality or noise. I'm not an expert, but there's obviously a lot going on that front. And I think that's bad for us as well, or bad for emerging markets, especially those who export quite a bit. And export is something we can't ignore because that's, I'm sure we'll talk later, is an integral part of our GDP pickup. So I think it's an uncertain time and a tricky time. All of this was pretty good 3 years ago, or at least when we spoke about a year ago. It's quite different now.
All right, so icing on the cake for India, out of all the headwinds that we already have globally, is also we are entering into an election year. So politically also, there are uncertain times. So how do you view India in particular as a foreign investor when it comes to India being an investment destination at this time?
We're getting into election, again, uncertain a little bit. I would hope from all foreign investors' point of view, there's a degree of continuity because what you have today going for us is pretty solid governance in a way in terms of just the government's attitude towards, obviously, the whole move towards anti-corruption, tax compliance. At least some of the reforms have come in significantly. So you need that to continue, and you need that degree of work ethic and conviction to get things done. So I think continuity is important from our point of view. I think the second thing is that India will continue to grow. I mean, there's no doubt about it. The question really is if it's coming again on the back of a pure consumption stimulus like we saw in 08, 09 after the GFC, then I think that's never sustainable structurally, right? So then you again have inflationary trends, and that doesn't really help. Thirdly, I think that India has now got to tackle the structural issues that were sort of hidden right now because all these were tailwinds, right? You had rates, commodities, oil prices, all quite benign, and now it's all changed. So you got to tackle the macro stability issue, and the macro issue actually for India has been something that we've been very pleased about because since this government has come, there has been a lot of stability on the twin deficits, generally on inflation and the currency. And now we are seeing a reversal of those trends. I wouldn't say the macro is unstable, but definitely inflation perks up its head every time you have a pickup in consumption or a constrained supply side. It's a supply-constrained inflation, and it always comes up. And then you got to tackle it by rates or whatever, right? So that's tough. And I think the second thing is that we have to watch out for the currency now.
For you, continuity of the government is very important. Fiscal prudence, inflation to be tamed especially, and owing a lot to the crude prices as well. So these are the few things that would be on your radar.
Yeah, absolutely. Just on fiscal prudence, I think you saw the tweet or a blog by the finance minister. Minister Jaitley that clearly fiscal prudence is number one on their mind, which I think is great. I mean, I've just generally been very, very hawkish on fiscal. I think that's the starting of all our problems.
Right.
So it's good that they're very good on that. And frankly, in the last 3 years, they haven't given away any major subsidies and all that. So wish, and I hope that in the last run that we have now, this remains under control. But it looks like they are quite hawkish on fiscal, which is great news.
The way the equity markets behave, that's also in some way a yardstick of how the overall economics is panning out, or at least a reflection of that. Now we've seen our equity markets go down, especially the mid-cap space lose its steam. What do you think about the valuations, and do you think that the outflows that we are seeing from the emerging markets, is that a worry and will continue?
Look, I think we've already, there's been a lot of FI outflow already, so that's a given. And I think that is more driven by allocations by these big funds and what they do. Our equity markets are extremely open, so you can come in and get out when you want. And I'm not really much of a student of the markets per se, but I would say on the valuations, they're generally expensive. I mean, the markets trade at 20, 22 times plus earnings, and I don't see 22% or even 16, 18% net income growth. So they're obviously trading at a pretty high PEG ratio.
Right.
So unless you can really demonstrate growth of that kind, it's tough to sustain these. Now, will India correct and will it come off? I don't think so, because there's such a wall of money always coming into the country.
Right.
And also the domestic savings in the mutual funds have been growing.
Right.
So you have a bit of a support there. But it could very well stay flattish for a few years, which basically means that you don't have much equity growth for a few years. It's possible.
Yes, but private equity side, that has played a very important role in the deal space over the last couple of years. You think that private equity money will continue to flow in?
There is no doubt that private equity and other forms of alternate equity and alternate long-term debt, there's a lot of it available. A lot of it is targeted towards India, and we are seeing a big deal flow for that reason. And it's further again aggravated a bit because the banking system is lackluster. So you see even banking deals coming in a way to alternate debt funds and NBFCs.
So your space is going to be a dominant player as far as capital is concerned, capital requirement of many businesses is concerned. You raked up the topic of banking sector. Is it the worst time to be a banker? You've been a banker with Citibank. Now, tell me, are we really at the bottom when it comes to the banking sector and the kind of issues that are plaguing the sector?
I don't know if it's the bottom or not, but I think we are reaching a point where I think every quarter of delay is going to cost us more to fix. So that's the good part about it. I think everybody recognizes that. So there is no discussion left about, what's a moral hazard, not a moral hazard. I think you just have to now save the banks and do what you have to do and do it quicker rather than later.
Yeah.
So the creation of all these committees, I think, is a fantastic step. If they can do a bad bank that we have publicly said is the right thing to do, cut the problem, make it a democratic process, move it on the side, tackle that problem, give the capital to the banks. I think it sort of puts a boundary around the problem then.
Right.
And then there's enough private capital which can come and help.
Right.
So I think that's a good one.
Right.
I mean, we can talk about bank consolidation and privatization, but frankly, it's, we're not an expert in this whole political economy. No point commenting about it and saying, I hope it happens. If it happens, great. If it doesn't, that's fine.
Sanjay, KKR has invested in so many NBFCs, financial services companies, and you continue to look at many others, as I understand. Now, do you think that this space is gaining at the expense of the banks also because banking sector is looking so bad that the NBFC and financial services still looks much more attractive? And how do you position the valuations in this particular space?
Look, there are many kind of NBFCs, right? So, I mean, some of the NBFCs today are trading at crazy valuations. So, they're doing what they're doing.
Right.
I just think that NBFCs are going to be extremely busy.
Right.
Whether they're asset-backed, obviously the mortgage-backed, structured finance, housing finance, SME finance. So, there's a lot of that going on. And I think those who are building a business model with the head on the shoulders,
right,
and not just worrying about valuations, having the right kind of a target market of customers, evaluating the customer's cash flows carefully, not just depending on some algorithms and fintech stuff, I think they will do well in the long run. But there's no dearth of business because of the banking issue. And frankly, you know, there is a growth in the retail sector, frankly, there is. I just fear sometimes the valuation and the hype may be a bit too much.
Yeah.
But just leaving that aside, the business is definitely there.
Yes.
Lots of new NBFCs coming up. I think they're all going to do pretty well if they can stick with the principles of, you know, really good credit and good credit management. They'll be fine.
You already have under KKR, and I always say that you're not a pure play private equity. You have structured finance as one vertical, you have real estate fund, and you have invested in Avendus, which is also growing pretty fast. So how will all this really come together when it comes to the NBFC and the financial services play for KKR?
I mean, our NBFCs now at KKR are about, the oldest one is 8 years old. The real estate one is about 4 years old. And they are very specific to certain target markets and the kind of business they do. And we're trying not to get away from that and stay very focused on generating good deals, good credit structuring, and solving the client's problems. And obviously being very, very conservative on the leverage we take. So our NBFCs are leveraged like 1 to 1.5 times. We don't have to go public. We don't have to impress anybody. We can just sit back there.
But would you plan to as part of your overall strategy later?
Who knows in the future? But right now, I think as things stand, to your comment that are we not a pure play private equity, I think we are trying to position KKR as a whole solution provider. So when we deal with a conglomerate or deal with a company, we're actually able to address a problem they have. And we have actually got some very interesting transactions where we have solved the problems for the promoter, for the company. Going in with a private equity hat, but then doing something else on the debt side, monetizing some real estate, coming back to private equity after a few years. So, you know, you develop a more of a solutions and a relationship approach.
Of course.
But that doesn't mean that all the 3 businesses or 4 businesses, including distress, have to not stand on their own legs.
Yes.
On Avendus, I won't comment, right? Because Avendus is basically a investee company of ours from our Asia 2 fund, so I'm not going to comment on that. I can just tell you they're part of our theme that we adopted a couple of years ago to back really, really high-class founders and entrepreneurs, to back them develop a platform. So I think they're doing a fantastic job on that.
Also, Sanjay, I always observe that you're quite a deal maker. Wherever you're invested, as you rightly said, that you look at monetization or some sort of a play. So there are mergers and acquisitions in most of the companies that you get involved in. So as far as deal making is concerned, do you think that some of the sectors that you're already present in, financial services, even hospitals, these two are seeing a lot of traction when it comes to many assets available? Are you going to also encourage your investee companies to really take that plunge and go for a higher play?
Yeah, I think you're right. Look, I don't think we do that much of M&A, but wherever we do try to find an angle, because one of the theses that we find in underwriting private equity in India is that you've got to get growth, simple. And I think we've talked either with you before or somebody else that in India, it is such a fragmented market. Anything you pick up is so fragmented. I mean, there are 12,000 NBFCs and God knows how many single and dual hospitals, how many financial services, AMCs, and God knows, there's just so much of everything. So one of the plays that we try to think is that if you can buy some good platform and back a good entrepreneur or a good founder, then can we go and help him, bankroll him in a way, and try to buy other things and make it a much larger platform.
Right.
Either filling some of our product gaps or client gaps, or as in the case of hospitals, maybe geographic gaps. So I think, consolidation and M&A is an integral part of our private equity thesis. More and more we're telling our people, if you're going to put up a private equity deal, one is top line growth, other is value add from KKR, okay, whatever. Third is what M&A can we do? Because I think India is ripe for consolidation across sectors.
All right. So, in particular, if you talk about hospitals, Radiant is making huge strides when it comes to Fortis. There are several other hospital chains which are available as well. So, are you seeing a big growth in this particular sector, especially?
I think we're seeing a lot of deals. Yeah, sure. We're seeing a lot of deals.
And you're interested?
We're looking at a lot of them. I think the Radiant platform is a great platform run by Abhay Soy. He's built a great platform already. I think we're going to keep looking at it.
Now that the valuations have come down considerably, Sanjay, and you have already made your returns and exits in the past, are you in entry mode, and are these valuations looking good now?
No, so the valuations in the market are quite high, right?
Still
I think,
high?
Oh yeah, absolutely. As I just said earlier, it's 20+ times earnings. It's quite high. But what is becoming interesting in terms of deal flow is that given indebtedness at conglomerate levels,
yes,
a lot of conglomerates looking at deconsolidating, a lot of promoters, discussions around succession planning. So that's creating a very interesting deal environment in the private space.
Right.
So that's clearly one area where, despite valuations being high in the public markets, you can actually have a reasonable deal construct in the private space.
Right.
So that's very, very interesting, right? I think the other thing that we have done, as I said, is that we are trying to back platforms and build platforms from scratch. So, we have a media content platform, we have the hospital platform, we have the financial services platform, and really back very, very good entrepreneurs to build.
Of course. So which are the sectors which are looking good at this point, Sanjay, for investments?
We're not really that, clearly we're not going to put money after expensive consumer companies. They're not going to do that.
So there's if we can say, like Horlicks is up for sale, Complan may also come in the market, and every private equity I know is chasing these kind of deals right now. Consumption theory and that story is still intact in India. Would you be chasing that?
Look, our job is that we have to go and look at every deal. There's no doubt about it. And being a firm with our brand name, we obviously get involved in everything. So we have to look at them. But we'll see where these things go. Prima facie, it's too early to say anything.
All right. And Telecom Tower is one space that you have massively invested in. And you continue to look very positive on that one to increase your deployment there.
Again, it's a investee company, so I can't comment on it. But generally, we think that Tower should be a good area to be in, just in terms of A, it's defensive, B, it generates a lot of cash. C, it's a very steady business. But can't comment anything else.
IT as well as pharma, they were laggards, and now suddenly market and the participants have found value in those sectors. Any particular sector which comes to your eye right now, which is undervalued and good for investment and probably ripe at this point to look at?
I think there's nothing prima facie that is cheap. I still think there are good industrial companies to go for. I think that's really where you have to look for good industrial companies that you can get at a reasonable valuation, you can improve them, and they are a derivative play on another sector, right? So that's one way to look at, that's how we look at things. Look at a first level or second level derivative of the consumption increase or e-commerce increase or real estate increase or financial savings increase. So look at the plays below that.
Right.
That's one way to look at how we try to find industrial companies. Yeah.
Haven't been averse to capital-intensive sectors at a time when none of the private equity players were present in cement. You had gone in there. So like that, are you still looking at that particular space, especially with so much debt-laden companies? You spoke about conglomerates, but apart from that, are capital-intensive sectors which really require cash?
So capital doesn't bother us, right? That's not the issue.
Yeah.
But you've got to be able to figure out the right cap structure going in. If these are debt-laden companies, then really what the issue is that you've got a pretty messed up cap structure. So you've got to figure out what's the role of the banks, what's the role of the funds, what's the role of the promoter, and you've got to right-size the cap structure. And that is the thing that's taking the most time in some of these stress situations we're looking at. I think now with the IBC, stabilizing in the next, I would say, 6 months, it's a great mechanism to catalyze the banks to start either settling, selling, or NCLT, whatever. So it's going to move much faster. So you're right. We're not worried about bringing in new capital of all kinds. but we'll have to get the counterparties like the banks to agree to what are the fair haircuts if we were able to settle them in cash. I think that's the biggest focus we have today. So capital is not the issue, but the issue is to get the right cap structure and the right size the debt to the EBITDA potential.
Okay.
And we would be happy to look at some deals just to get the process going. But really, we haven't done much, frankly, till now.
Decision making when it comes to investments is a concoction of many factors. But what really is on top of your list, which is one most important eligibility criteria that you look at for any company to invest in?
A good promoter is the first and probably 50% recipe for success.
All right, well said, and I've been taking notes on that as well.
Right.
Thanks so much, Sanjay, for such a candid conversation. And we'll be hearing more about deal flows from your side as well.
Thanks.
Thank you so much. So that was Sanjay Nayar, a candid conversation on Big Deal. Thanks so much for tuning in.